Good afternoon everyone. So today we are moving towards another point of treatment of undistributed profits and reserve, undistributed loss on change of profit sharing rate of existing partner. Okay. First one was where the accounts of undistributed profits and undistributed loss are to be closed before the changing of ratio. But here second point is about continue even after the change of ratio. What to continue? The amount of undistributed profits and reserve undistributed loss are to be continue even after the changes in profit sharing ratio of the partners. Okay. So in such a case, when we do not have to close the undistributed profit and reserve account, undistributed loss account, and we have to continue them even after the changes in profit sharing ratio. Okay, so the proportion of undistributed reserves profits which bears to the amount of gain is ascertained, and accordingly transfer entry is done by capital transfer. Okay, not by closing the account. If there is any undistributed loss, then the net difference between undistributable profits, reserves and losses are ascertained, and on that basis the amount of difference is transferred to partners' capital account in proportion of their gain and sacrifice. Okay, so this means if there is any undistributed loss, okay, then the net difference between undistributed profits and reserve and losses are ascertained on that basis. Okay, on that basis means on the basis of undistributed loss. The amount of difference is transferred to partners' capital account in proportion of their gaining and sacrificing ratio after deducting new profit sharing ratio from the old ratio. Okay, the gaining partner must have to compensate to the sacrificing partners or sacrificing partner. Okay. So now moving towards, for example, for depth knowledge, X, Y, Z are partners sharing profits and losses in the ratio 3:3:2. Okay, X, Y, and Z were partners and are partners sharing profits and losses in the ratio 3:3:2. Their balance sheet as on 31st December 2020 was as like: sundry creditors are there in the liability side, outstanding expenses, general reserve are there, capital accounts this amount, and in the asset side, cash at bank, sundry debtors, there is a provision for sundry debtors 2000 and the balance is 22,000. Stock is there, machinery, building. So what is there in the additional information? Partners decided to effect from 1st January 2021 they would share profits and losses in the ratio of 4:3:2. So their earlier ratio was 3:3:2 and new ratio is 4:3:2. So what will be the gaining ratio or sacrificing ratio? Changes in profit sharing ratio. Okay, profit sharing ratio. This is the old ratio and this is the new ratio. Okay, from old ratio we have to deduct the new ratio. So X, Y and Z, old ratio are 3:3:2. So 3/8, 2/8 less 4:3:2, 4/9, 3/9, 2/9. Okay, so the difference will be for X, Y and Z. 72, 72 and 72 lower part. Okay, so $27, right? Then 72, 27, 32 minus 5/72. Again here, three by 72. Here 2 by 72. So this is the gainer and these two are the sacrificing. Okay, sacrificing partner, gaining partner. Okay, so in general reserve, as well as if there is any goodwill, general reserve is there. So in general reserve, the partner X has to compensate the sacrificing partner Y and Z. And is there any goodwill? So there is goodwill. Goodwill of the firm is valued at 54,000. That goodwill also have to be compensated by the gaining partner to the sacrificing partner Y and Z in their respective profit sharing ratio. Okay, sacrificing ratio. So in the changes, there is also some additional information. Machinery is to be depreciated by 10%. Machinery is there 80,000, so 8,000 have to be deducted. Okay, building to be appreciated by 20%. Building is there 1 lakh and 20%, that is 2,000. Okay, 1 lakh into 20%, 20,000. Okay, 20,000 have to be increased. Stock to be valued at 56,000, so stock is depreciated by 4,000. Debtors are to be valued at 20,000. There is another provision for doubtful debt, that is 2,000. Then a liability for 1,400 included in sundry creditors is not likely to arise, so there is a profit inside of sundry creditors that 1,400 is not to be paid off. A liability for outstanding printing for bill and 1,000 is to be brought into account, so liability means extra payment is there. Outstanding printing bill, that is 1,000. Okay, so liability increases. Partners agreed that the revised values are to be recorded in the books. They do not, however, want to distribute the general reserve, so that will be maintained in the new balance sheet. Goodwill of the firm is valued at 54,000. Goodwill account not to appear in the books. Okay, so goodwill of the firm is valued at 54,000. That goodwill have to be distributed among the sacrificing partner, and the gaining partner must have to compensate them. Okay, goodwill account not to appear, so that will be distributed among the partners. So we are here required to give journal entries, capital accounts of the partners and revise balance sheet. So first journal entry will be according to revaluation account, that what is upgraded and what is decreased. Okay, increase and decrease. So here you can see what is increased. Machinery is to be depreciated. Okay, building is to be appreciated. So depreciation is there in machinery, in provision for doubtful debt, in stock. Okay, and also there something that is liability for printing of bill is there. Okay, so these all are losses. So revaluation account to machinery. Machinery means 80,000, 8,000. 10% is depreciated, 8,000. Okay, 8,000. Then to stock, 4,000, 60,000 was there, and now we have to value it at 56,000. 4,000 is. Then depreciation for provision for doubtful debt, that is 2,000. Okay, and again outstanding printing bill liability 1,000. These are all decreased under revaluation account 15,000. Again now we have to increase. What have to increase? Building is to be appreciated by 20%, that is 20,000 will be increased the value of building. After that building account debit 20,000. Then liability for 1,400 included in sundry creditors is not likely to arise, so this 1,400 is profit. So sundry creditors account debit to revaluation 20,000 and 1,400. 21,400 is the profit or gain in revaluation account. So what is left in revaluation account? From 21,400 we have to deduct 15,000. Okay, 6,400 is there. That 6,400 will be divided among the partners in their old profit sharing ratio. 6,000 6,400 into all profit sharing ratio was 3:2. 3 by 8, 2,400, then 6,400 and 2 by 8. So 1,600. 2,400, 2,400 and 1,600 is the division of revaluation profit among the partners in the whole profit sharing ratio. Okay. So X has to brought in capital, right? And this is the value of X, Y and Z. So X is the gainer here. You can see X is the gainer of 5 by 72 and Y and Z are gainer sacrificer of 3 by 72 and 2 by 72 respectively. Now X has to compensate the remaining sacrificing partner in general reserve as well as in goodwill, because goodwill of the firm is valued at 54,000. That goodwill must have to be compensated by the gainer. So that will be distributed among adjustment for goodwill. C. X has gained, he will be debited with 5 by 72 of goodwill. 5 by 72 of goodwill means 5 by 72 of 54,000 rupees. Okay. From 54,000, 5 by 72 will be compensated by X as he is the gainer, and Y has sacrificed, so he will be credited with 3 by 72, that is 2,250. Okay, and Z has sacrificed, so he will be credited with 2 by 72 of goodwill, that is 1,500. That total of 3,750 will be compensated by X as he is the gainer of the firm. Okay. So he will be debited with this amount of 3,750 in case of goodwill. After that, we can see there is a general reserve amounting to 27,000. That 27,000 must have to be compensated by the gainer to the sacrificing partner. Sacrificing partners are there Y and Z. So X has to compensate from 27,000. X will compensate his share of gaining, that is 5 by 72. Amounting to 1,875 of this general reserve. Okay, and Y has sacrificed, so he will be credited with 3 by 72 share of his sacrificing ratio from 1,125, and Z will be get credited with 750. Okay, so that's why the journal entry will be X capital account debit 1,175 to Y's capital account to Z's capital account in case of general reserve. So X capital account debited and Y and Z's capital account is credited. After that, for goodwill, X capital account debit to Y's capital account to Z's capital account, and X capital account will be debited with the compensation of goodwill of 5 by 72 from rupees 54,000, 3,750. Okay, C. And that will be distributed among the sacrificing partner in their new sacrificing ratio, that is 3 by 72 and 2 by 72 respectively, 2,250 and 1,500. Okay, credited. Now we have to prepare the partner's capital account. For partner's capital account, first of all, we have to put on the capital brought in by them, 1,80,000 and 70,000. 1,80,000 in case of Y and Z, 70,000. Okay. By revaluation account, they got the profit 2,400, 2,400 and 1,600. After that, they got the share of general reserve as a compensation from the gaining partner. Okay. So that will be X capital account. By X capital account, share of general reserve within bracket, that will be compensated by X. That's why we have to write down by X capital account. That will be debited to X capital account, to Y's capital account, to Z's capital account, 1,125 and 750, 1,125 and 750. Okay. After that, we have to put on the compensation made by X for share of goodwill, 2,250 and 1,500. Okay, that will be debited in X capital account, to Y's capital account, to Z's capital account, 2,250, 1,500. That is compensated by X as the gainer. Okay, so the balance will be 96,775 from 1,02,400 total in case of X, and Y's capital account balance will be 85,775 and Z's capital account will be 73,850. Now we have to prepare the new balance sheet. Okay, balance sheet as of X, Y and Z as on 1st January 2021, new balance sheet. So in the balance sheet we have to put on cash at bank 27,000. Okay, 27,000, sundry debtors 24,000, provision will be 4,000. Why 4,000? Because it has to be valued at 20,000. So for 20,000 from 24,000 we have to deduct 4,000. Extra 2,000 have to be added because debtors are to be valued at 20,000. So provision for doubtful debt 4,000 and valued at 20,000. Again, stock is there 60,000. Stock has to be valued at 56,000. Stock will be 56,000. Machinery is to be depreciated by 10%. Machinery is there 8,000. So from 80,000. From 80,000 we have to deduct 8,000, that is 72,000. Okay, 72,000 will be valued as machinery in the new balance sheet. After that, building has to be appreciated 1 lakh from and 20,000. So 1,20,000 will be building. Okay, see this side total is 2,95,000. Now we have to put on the liability side sundry creditors 10,000, and from that 1,400 has to be erased because that has not to be paid off by the firm. Okay, 1,400 is deducted 10,000. From 10,000, 400 is deducted 8,600. Creditors for printing. Okay, creditors for printing is there extra payment. Extra payment means extra liability. Creditors for printing 1,000 is bill as there. Okay, so this is the 1,000. After that, in the liability side there is outstanding expenses 2,000 has to be put on, that is given. After that, general reserve has to be maintained in the new balance sheet, that is not to be written off. That's why 27,000 is write down in the liability side. After that, the balance carried down from the partners capital account is shown here in X, Y and Z. So the total of capital of all the three partners 2,56,400 and the balance sheet total is 2,95,000 for both the liabilities and asset. So now you can see how to prepare. First of all, calculate the sacrifice and gaining ratio when the partners once or decided already to change their profit sharing ratio, and they also want to continue the remaining profit, remaining balance reserve, remaining undistributed profits and loss, undistributed reserves, undistributed anything left. So that has to be continue even after changes in profit sharing ratio. For that, we have to calculate first of all the gaining and sacrificing ratio. After that, the gainer has to compensate in all cases if there is any goodwill, general reserve, anything else there, which is usually divided among the partners. So the gaining partner or the gaining partners has to compensate the sacrificing partner or sacrificing partners. Okay, so for that we have to calculate the adjustment given as in case of revaluation account. For that we have to put on the journal entries. After that we have to divide among divide the general reserve if there is any and goodwill in their sacrificing and gaining ratio. After that we have to put on this amount under capital account. Okay, partners capital account, and after that the new balance sheet is prepared. Okay, this is very easy. From the next class we will discuss about the another chapter after admission of a partner, that is retirement of a partner. What to do, how to calculate, how to do the accounts at the time of retirement of a partner, the treatment of goodwill, continuing of the partnership farm, all these will be discussed in the next class. Okay, thank you.